In this session, I would like to discuss about the cash flow models, which actually form the basis for the various financial investment decisions. The cash flows form one of the important elements or the core elements. As we move along, we would also see a word called discounted cash flow models. Those are the ones that are used for valuing any investment, finding the worth of any investment. So, understanding the cash flows is one of the important aspects of any investment, of any decision making process. So that is where we are trying to have a brief introduction on what is this cash flow all about and what kinds of cash flows are associated with what kind of investment. Some common examples of cash flows associated with different investment are also considered. So just to start off, see, for any investment decision, what people tend to do is they try to project. When I say I'm doing a financial investment evaluation, my intention is nothing but I will have a projection of all the future cash inflows. What all? Let's say I am I am investing my money, or I have lent, I have given a loan to someone for a period of 5 years. And as per that loan agreement, every year at the end of the year, that party, that borrower has to pay some interest. And let's say at the end of 5 years, along with the interest, he has to give back my loan amount. Now, in this financial transaction, this is what we call as a financial transaction. In this financial transaction, there are some places where money is going away from my pocket, like when I have given a loan, money has gone away from my pocket. So when money is going away from our pockets, we call it as outflow, or in the language of cash flows, we say there is a negative cash flow. And when at different points, let's say after 1 year, the person is paying some interest. After 2 years, the person is paying some interest. So there are some monies that I am receiving in the form of interest, and probably even the loan that has been given, that also is refunded back, which means I am receiving. So wherever the entity is receiving the cash, we call them as cash inflows. So for any investment, for any kind of financial process, there are some inflows and outflows for the future, right? There are some inflows and outflows of cash in the future dates, and that projection of the inflows and outflows at various points in time in future is what we call as cash flow analysis. So how do we how better we are able to build those cash flows from the various investments, because in some cases the future cash flows are known. Like if I do a fixed deposit in a bank for 5 years, I will be knowing the bank on the day I am doing a fixed deposit itself, it will mention what is the amount I will receive on the maturity date after 5 years. So what is the amount that I will get in future and after what period I will get that money. So the timing as well as the amount of the cash flows for the future are known in advance in some kind of investments. Whereas in some cases, the timing and amounts are not known also. That is where the whole complexity of the financial process lies. The timing and amount of cash flows, both when I will receive, how much I will receive, both of them may not be known in advance. But of course, the inflows and outflows, whatever I am able to project, for each point in time, we'll try to do the netting. Netting is nothing but the excess of inflows over the outflows. So at the end of first year, okay, what are my total cash inflows? What are my total cash outflows? Then the difference between the two is what we call as the net cash flow. If it is positive, then we say it's a net cash inflow. Otherwise, we'll say net cash outflow. So, this is a very important job. It's a very important function in many organizations because the real value of the firm, we'll see later, the real value of the firm depends very heavily on how these cash flows are managed. And if at all the timing and the amount of cash flows are unknown for so many securities, for so many investments, sometimes the investment world uses the word called security, which is more like a tradable instrument. We'll talk as we move along. Tradable is once I have given the loan to some party, right? And it may so happen that I will sell off this loan to someone else for one fixed amount. Now, because of that, what happens is I am receiving the money from this party, but now this party will keep receiving the principal and the interest payments. Like that, every financial instrument, it has or to a large extent, the financial instruments have the feature of being tradable. Means even if I have owned one security, one bond or one share or any such thing, I can very well sell it off in any of the markets and exit out of that position. So that is what we are calling as tradability. Of course, now if the timing and amount, both of them are uncertain, generally that is where we bring in the role of probabilities. We try to assign, okay, there is a 30% chance of receiving 500 bucks, but there is a 60% chance of receiving thousand, and probably there is a 10% chance of receiving zero. So the existence, especially if the cash flows are uncertain, we will have such kind of probabilistic based models. And of course, these probabilities generally are designed based on historical experience from the past data. And if the past data is not available, at least similar kind of instruments, similar kind of securities is where this information is derived and tabulated. And here there is one more word. Let's say we are talking about the timing and the amount. If the timing, see, sometimes we have the timings like, okay, the interest has to be paid annually, or in some cases we may have a monthly payment. But in some cases the payment could be, let's say, daily, especially in the case of microfinancing. where the interest rate payments could be either a daily or weekly, means at a very frequent intervals of time. We call those kind of payment models as continuous cash flow models. Right? It's easier to go with the word continuous. Continuous means at very regular, very frequent time intervals, the cash inflows and outflows are happening. So this is what is a very brief introduction to the cash flows. Now we will see for various financial instruments, the very common financial instruments, what are the typical inflows and outflows associated with them. So to start with, we talk about a zero coupon bond. As a word means, see, whenever we talk about a bond, it is nothing but it's a form of a loan, right? It's a form of a loan. So issued by some government or from some corporations, some big companies for raising capital, means for borrowing. Instead of borrowing from a bank, if they borrow directly from a bank, we classify it as a loan. But if they borrow, let's say, from public, they can do that, means multiple people, multiple sources in smaller amounts, but total becomes very large. So instead of directly taking a loan from the bank, they can issue a bond issue. They can issue a bond and raise capital. Now the people who all are investing in that particular bond are called as investors or even the holders of that bond. Now these people, as per the terms and conditions that are mentioned in the bond, these people may receive whatever they have invested. See, at different points in time, let's say this bond is issued for 5 years. It may mention that at the end of each year, some interest will be paid, and probably in the final year, which is at the end of 5 years, even the face value of the bond will be refunded. So here the bond is quoted based on face value. Let's say a face value, generally, let's say if I am talking about it as 1000, it means that on the maturity on this particular date, a value of 1000 will be paid to the investor. It's the worth of the bond. The face value is what is the typical notional value of that bond. And on this, if at all there is an interest at each of the periods, that interest at each of the period is actually called as a coupon. So if I say coupon is 7%, it means 7% of this face value, which is 70, is received every year. And the face value of 1000 is received, let's say, in the final year. So the payments wise, 70 will be received after first year, 70 after second year, 70 after third, 70 after fourth, and 1070 after the fifth year. Now these are the inflows that are going to come. Whereas when it comes to outflow, whatever is being paid to purchase that bond, whatever the investor is giving to the company, whatever the price at which this bond is purchased, let's say 975. This is called as the purchase price or the invested amount. Now what we are saying is this amount can be either less than, this amount is less than or equal to or greater than the face value. If it is less than the face value, we call it as discount bond. If it is equal to the face value, we call it as par bond. And if it is greater than the face value, we call it as the premium bond. Now, just small improvement on that. So, if these periodic payments do not exist and only the face value is paid on maturity, we call those kind of bonds as zero coupon bond, because coupon is zero at each of the intermediate intervals. There is literally no payment that is being received. So which means there is one cash outflow on the investment date, which is the invested amount, and one cash inflow on the maturity date. No intermediate cash flows at all. So it's as good as a loan where the entire loan amount along with the included interest is paid on the maturity date itself. No in between interest payments. So that's the reason we talk about for such kind of instrument, the negative cash flow happens on the date of investment. From a lender's perspective, there is a negative cash flow on the date of investment and a positive cash flow at a future date. But one thing we have to understand, at a future date, see today I have given it, there is a negative cash flow, today I have lent it, but there is no guarantee that I will get this back after, let's say, 5 years. So there could be some possibility, I'm not saying assured, but there is some chance that this money cannot come back, and that is what we call as risk of default. So when I'm depending on the party to whom I am making a lending, let's say I am lending it to government, very less chances of default. I will be very much assured that I will get back my money. But if I am lending it for some startup companies, there is a very high chance that they may close down within the next few years and my money may not come back. So the risk of default is much higher in those cases, and wherever the risk of default is higher, generally we see that the interest rates that are defined on them will be higher, because the typical fundamental for us is high risk of default, charge a high return on that. That is the only motivation for anyone to invest in that kind of security. So when I talk about a regular coupon based bond, even these coupons will exist every year along with the face value, which will have different cash flows at different points in time. But in case of zero coupon bond, at least all cash flows, the timing and amount, both of them are known well in advance. Even in a coupon bond, as long as the coupon is fixed, there may be scenarios of fixed coupon as well as floating coupon. As long as the coupon is fixed, in the coupon bond also, all the timing as well as the amounts of the cash flows are known in advance. The only thing with respect to a regular coupon based bond, or for that matter any bond, the difference from a loan is there is a possibility that that bond can get traded, Whereas a loan, which is an agreement between a company and a bank, very limited chance to trade that. Whereas when a company has issued a bond and raised the capital from the public, that bond can be listed on a recognized exchange, which can be traded between the various parties. So, as I said, the holder of the bond will receive a lump sum face value on the maturity date, and along with that some intermediate payments at periodic intervals of time, and the intermediate payments are called coupons. If the coupon is fixed, in some cases the coupon may be fixed, in some cases the coupon may be floating. If the coupon is fixed, then the timing and amounts of the cash flows are fully certain. But if the coupons are floating, let's say based on the prevailing interest rate at each of the periods, I may have to wait for the period, for each period, to know what is the interest rate at that particular period, to understand how much amount will be either received or paid. So there is a lot of uncertainty in those kind of payments. So typically we need to understand from the cash flows dimension whether that particular cash flows which we are receiving, the timing and amounts of them are certain or uncertain. If they are more uncertain, we assign the probabilities and try to compute their expected values and then proceed for the calculation purposes. And if they are more and more certain, I can directly take their certainty values itself. So coupons in general, they are paid either on an annual basis or semi-annual basis, but even more frequently or even less frequently also they may be paid. So when I talk about a zero coupon bond, it's generally a special case of this coupon based bonds, which are otherwise called as fixed income securities in general. They are the zero coupon bonds are a special case of them where the coupon is equal to zero. So just to look at the cash flows associated with these kind of instruments, there is a negative cash flow on the date of investment, a series of small positive cash flows over the period of the loan, which are coupons, and a large cash positive cash flow, which is the principal repayment or the face value repayment, which happens on the maturity date. And the price at which you are purchasing that particular bond, as I said earlier also, it may be greater or lesser or equal to the face value. If it is lesser, we call that as a discount bond, equal to we call it as a par bond, and greater than we call it as a premium bond. Then we have other kind of securities that are very commonly seen. They are called as the index linked securities. If we look at the earlier two, the normal fixed income securities are a special case of them, which are the zero coupon bonds. There are fixed amounts that are fixed cash flows that are received at future periods and even on the maturity. Now, these fixed amounts that are getting received, their worth can be more or less based on inflation existing. If the inflation is very high, these amounts will worth nothing, right? Probably it's like this. If right now my salary is 100, after 1 year my salary is increased by 5% and it has become 105. Whereas in the meanwhile, the price of the goods, price of all goods, which is a measure of inflation, let's say has gone up by 10%. Suddenly, whatever I used to buy with 100 bucks in the last year, that may not be bought with 105 bucks this year because the prices have gone up by 10%. So my savings are actually going down even though my salary has gone up, which means my purchasing power or the value of my money is actually going down because of inflation. So that is what is being tried to be addressed by this index linked security. What this index linked securities does is this future payments, whatever the coupons or the face values, whatever are going to be received in future, they are linked to an index, inflation based index, probably a consumer price index or wholesale price index. They are linked to this index. So if the inflation is high, the payments that are received will be higher. Inflation is less, the payments that are received will be lesser. So in a way, that makes the cash flows more and more uncertain, because I should be able to project what would be the inflation at that point in time, and based on that I should be able to predict the cash flows that will be received at that point. In a way, it makes the cash flows more and more unknown. So here the only difference between the regular fixed interest securities and the index linked is the future cash flows are unknown, like both for the coupons as well as the face values. Whatever the cash flows that are going to be received in future are going to be unknown. Though we know that they may be positive, but the exact value for those things may be unknown. So in general, we use the words real, real returns, real cash flows means I am adjusting them for inflation. The impact of inflation is considered into the cash flows. But wherever I use the word nominal, nominal returns, nominal cash flows, nominal amounts, there the inflation part is not considered, means it is ignored. So we have to really understand whether the cash flows that we are talking of are inflation included or inflation ignored, which means if the inflation is, if they are inflation included, like index linked securities are real cash flows, whereas your fixed interest securities are zero coupon bonds, they are nominal cash flows. Because in real cash flows, if the inflation is higher, the cash flow will be higher and vice versa. But one thing we have to understand here, one simple measure that needs to be understood is the interest or the inflation index. We said that the coupons will be based on an inflation index. Suppose I have purchased an instrument, let's say in 2012, and so my first payment, let me assume that I will receive in 2013 1st Jan, right? 1st Jan 2012 is when I have made the investment in an index linked security. I will receive my first coupon, let's say in 1st Jan 2013. There I would be looking out. So if I want to know the index on this date, it becomes very difficult, because the index calculation, the WPI or consumer price index or whatever the index we talk about, the computation of index is a time consuming part. So I don't want to depend on the index at this level. For majority of the investments, the index as on this date means previous period. Probably when I am getting my next cash flow, which is 1st Jan 2014, I may depend on 2013 index value. When I am getting on 2014, I may depend on 2013 index. When I am getting on 2013, I will depend on 2012 index. The reason being, the index computation takes some time, and by that time which I need my cash flows, I cannot wait for that. Two, the investor, he would at least, okay, he doesn't know what are the cash flows that he is going to receive in the next 5 years, but at least he should be knowing how much he would be receiving at least in the next period. So even from that dimension, it always, to a large extent, it goes that for the index linked securities, typically the index as of the previous period is taken as the base for computing the coupon as well as the face values that need to be paid off. Then the other set of securities that I can talk about, which is something which all of you might be comfortable with, which is a bank deposit. Right? If we look at the characteristic of bank deposit, probably especially the savings accounts. The savings accounts otherwise are called as call deposits, wherein you can invest the money at any point, you can deposit your money at any point in time, you can withdraw the money also at any point in time. So there is no fixedness in the period, there is no fixedness in the amount that you can deposit and withdraw, and at the same time the interest rates on your savings accounts, they can very well be changed by the bank without any prior intimation to you. So the deposit which you have made today might undergo different interest rates at different points in time, which is not fixed for the period of your investment. It can change whenever the bank wants to, which is more at a discretion of the bank, and you might be informed about it at a very small interval of time. You may not be given enough notice for that also. So in a way, the amount as well as the timing of the cash flows is completely uncertain. But at the same time, in terms of those banks, there are something called term deposits, which are more like fixed deposits. The better example of a term deposit is a fixed deposit, where at least you deposit something now, you will be receiving an amount which is fixed, probably after a fixed period of time. The only thing is the interest rate for this entire period generally might be fixed, or in some cases even that interest rate also might be floating. And one thing is, these particular instruments generally are non-negotiable, means I cannot exit out of my fixed deposit before the period. Let's say I have taken a 5-year fixed deposit. If I want to withdraw, let's say after 3 years, I cannot sell this instrument to someone else and get the money. But if it had been a bond, there is a market for selling those bonds, and I can literally exit out of the bond after 3 years. But if it is a fixed deposit, I cannot sell it to some other party, let's say at the end of 3 years, and exit out of it. The only thing is probably I can exit out of it by having a discussion with the bank and paying a price for it. I can very well try to exit out of those fixed deposits. That is one way. That is the way the cash flows with respect to the fixed deposits look like. For at least call deposits, the amount and timing, both of them are not known. Whereas with respect to term deposits, at least if it is a fixed term, fixed amount kind of a deposit, all are known in advance. But if the interest rates are non-fixed, or even if they can be redeemable, or if the party exits at any point in time, the cash flows will become uncertain for those kind of scenarios. Then we are talking about the equity investments. Especially these are the securities that are held by the owners. These are not like loans. I am not lending to someone who will be paying the interest and principal on that. I am actually investing in a company. Means it's actually as good as I have taken the ownership in a company. When I am buying a share, it's like I am buying ownership in a company. So there is no fixed amount, no fixed interest that I receive on this. Instead, I would be compensated with a share in the profits of the company. So if the profits are higher, I will get a higher amount. If the profits are lesser, I will get lesser amount. And sometimes I may not get anything at all also. So that is what is like an equity capital, which means the amounts which I am going to receive in the future, the timing of the amount that I am going to receive, they are all uncertain again in an equity investment. The company actually pays from whatever the profits that are acquired during a future period. So if the profits are higher, probably my share of the profits will be higher and vice versa. But what could happen is the company may pay out the entire profit, or it may want to retain some of the profit, especially for funding the new projects or for compensating the years where the poor profits are going to come up in future. So they may pay only some portion of that profit, and that is what we call as the dividend, and retain the remaining portion for these kind of things. If the company wants to expand, if the company wants to get into new projects, it requires some new capital. So for that purpose, it cannot again borrow. So it can so happen that the profits of the existing investors only are retained and used for funding the new projects. And if at all in a particular year the company did not do well, got into losses, in order not to make any payment to the investors, because it retains some of these existing profits, so that even in a bad year some kind of payments can be made to the investors. So that makes the amount as well as timing of the cash flows completely uncertain. And as an investor or as an analyst, the assumptions need to be made very properly about the growth of the company in the future, which means the growth in the profits, so that the share of the profits can share of the proportion of the profits increase for the investor. And the other important criteria with equity investments is there is no fixed maturity period. They are held until perpetuity, means forever, until the company closes down. And but you have the facility of redeeming them or trading them in the secondary market. There is a secondary market that exists for the same. So you can think of trading them in the secondary market. Especially if there is an exchange for the same, which is very liquid and which is very active, the trading can happen and you can exit out of your investment by selling it in the secondary market. But otherwise the shares are held until perpetuity. So forecasting the amounts and the timing of the cash flows, because in some cases the dividends can be made twice a year, thrice a year, every quarter. So the timing of the payment is uncertain, the amount of the payment is uncertain. So that is where the analyst has to focus more on predicting these cash flows, so that a proper evaluation of that financial instrument can be done. But one more thing about the equity securities is, in case the company is failing, the investor will get the share of the assets of the company only after the payments for all the lenders and all the other liabilities of the company have been made. They are the guys who get the last possession in the assets of the company. So it may be much lesser or in some cases they may not get anything, they may not get their capital back also. So that is the reason we call equity investment as the risky investment, because as long as the company is doing good, probably what they are getting may be much more than the lenders, but if the company is not doing good, what they might be getting is much lesser than what a typical lenders are going to get. So those are the cash flows that are associated with equity securities. Then the other type of security we can look out for is annuity certain, which is more and more similar to the concept of pensions, wherein I invest a lump sum today, and after that I would be receiving probably a fixed payments every year for some number of years. So here in this, the frequency at which I will be receiving, the number of years during which I will be receiving, and the amount that I would be receiving, all of them would be specified at the time of the beginning of the agreement itself. So there is a negative cash flow at the beginning, one single lump sum negative cash flow in the beginning, and a series of regular cash positive cash flows over a period. But in some cases, this number of years over which this payment is done is uncertain, because there might be a linkage with the survival of the person. As long as the person is alive, these payments will be received. That is a typical concept of the pension also. As long as the person is alive, he will be receiving these fixed payments, and it may be up to 110 years, or it may be up to 55 years, or it may be up to 75 years, whatever it is. So which means the cash flows, the number of payments that would be received on that lump sum investment, they are uncertain. So that is what the prediction should happen based on the mortality rate, based on the life expectancy. Some kind of predictions may have to be made with respect to the number of years the person would be alive, and based on that the payments can be decided. So this is one more challenging area which has different characteristics with respect to the cash flows. And one more dimension that is worth looking at is the loans. In the loans, there are two concepts. One is I make a loan and I receive the interest regularly. I receive the interest regularly, and a principal or whatever the amount loaned amount, I will get back at a future date. This kind of loan is called as interest only loan, where at each of the periods the interest is being paid, and finally the amount that is loaned is refunded. So there are a series of interest payments along with the return of the principal, as similar to your fixed interest securities itself. But the only difference being, in some cases this interest rate may be floating, then the amount of cash flows is uncertain, and this kind of product may also have early repayments, otherwise called as prepayments. Early repayment, otherwise called as a prepayment, can also exist for this kind of a product. That makes even the timing of the cash flows being uncertain, because if there is an early repayment, the whole principal is refunded at this point only, rather than waiting up to this. So in those cases, especially if a person wants, let me get out of this loan, why should I have this burden until next 3 more years? I have the cash, so let me pay it off. If he thinks like that, there is a possibility of doing an early repayment on the loan also, which will make the timing of the cash flows also uncertain. So which means from an analyst dimension, even the timing of the cash flows need to be assessed based on some kind of the predictive models. Then the other normal kind of loan which we hear is the EMI based loan, equated monthly installment base. Okay, the bank will make a loan, but what will happen is at regular intervals there is an equal amount that is being paid, which will include some principal as well as some interest payments. The whatever the payment that the party is paying, it will have an interest portion plus some portion which is the repayment of the principal. So the principal is repaid to some extent in each of the periods. So that is called as a repayment loan or a mortgage kind of a process, wherein some partial repayment of the principal is happening, but it is made sure, it is generally looked at like, if I add up the interest and principal during any period, it comes down to an equal value. That is where we call as equated monthly installment. So in the initial period, and we know that interest is always applicable on the principal that is outstanding. So in the first period, the full principal is outstanding. So the interest will be applicable on that amount. But in the first period, some principal is getting repaid. So which means the principal that is outstanding is actually coming down. So because of that, the interest for the next period will become lesser and so on. But the overall payment that is being received is equal, which means as the time period increases, the interest portion of it comes down, but the principal portion of the loan goes up, and it is ensured that both principal and the interest added together will be a sum which is equal for the entire period. So that is a typical repayment loan mechanism where some portion of the interest and the principal repayment happens. In general, what we see is as time passes, the interest amount keeps coming down and down and down. The principal portion goes up and up and up, whereas the total amount that is being paid will always remain constant, which is the sum of the principal as well as interest, which works out to some number. This is the typical mechanism of a repayment loan stuff. As long as the interest rates are same, the cash inflows and outflows are fixed. But if the interest rates are variable, then probably even these numbers are bound to change over a period. So as far as this cash flows is concerned, it is very important for us to understand that whether the cash flows are fixed or variable, they are certain or uncertain. The amounts as well as the timing of these cash flows, we need to understand whether they are certain or uncertain. If they are uncertain, what is the mechanism to predict those things, and what is the way we can assign the probabilities to those cash flows, because that forms the most important stuff to value any kind of investment decision. So that is where we need to be comfortable with, understand the cash flows of each and every investment, the timings and the amounts. If they are uncertain, how do we use the probabilities and the mechanisms to arrive at the predictions of those cash flows? This concept has to be kept in mind for solving all the problems associated with the investments. Alright. Thanks a lot for listening to this session. Thank you very much.